Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. We got a full set of hosts. Tisa, great to see you.
Good to see you, Paul. Good morning, everyone.
And Bruno, welcome.
Thank you. Good morning, everyone.
Ramsey, as always, you're great to have you here.
Good to be here.
You're always missed when you're not. So anyway, today's episode is, I think, a favorite topic of us on most episodes, but it's about trying to make the FIA market a little simpler. So today we're bringing together somebody who's been on a show a couple of times before, so one who hasn't, but two leaders in the annuity space who are in the process of introducing a new approach for agents and financial professionals who may be struggling to make sense of the many choices when recommending FIAs to customers. So that includes both what product to put in front of them and when you go to fill out the application, what of the 20 boxes do you check for product allocations? How much do you put in it? So we're joined today by Mike Odor, Vice President and Head of Annuity Sales at Midland National, and our friend Branislav Nikolic, Managing Director and Head of Insurance at the Index Standard. So these two great people have sort of launched a project to put a system in place to help agents make more informed decisions about what they do with their FIAs. So Mike and Branislav, welcome, and tell us just a little bit about who are you and what exactly are you doing in this space? Maybe start with you, Mike.
Yeah, well, good to be on. Thanks for having us, Paul. And it's always, anytime we can talk about FIA allocations and how we can make them more simpler for the industry, sign me up. I'm all in. But I lead sales and distribution for Midland National's annuity division. That's our direct channel, which consists of life licensed and investment advisor reps that are not affiliated with broker dealers. And, just due to our very nature of being a direct partner and working directly with our financial professionals, anytime we can be kind of at the forefront of education to make these things more simpler to understand is a huge win. So our partnership with the Index Standard to this point has been fantastic.
Branislav, tell us.
Hey, everybody. Glad to be back. Always a pleasure to chat with you all. And as Mike said, this came really natural and in line with the mission and the vision of the Index Standard. We talked about a quote unquote generic version of this project maybe a year and a half ago, where really our goal is to help people make decisions based on actionable insights from annuity parameters, annuity features, and based on our forecasts that we produce for indices. So with that said, we are extremely glad to partner with Midland National on this. There was a lot of hard work that went into this and basically customizing it to the point that the agent or financial professional has an easier time when educating their client, but also making them comfortable on what they can expect from an annuity in year 2, 3, and going forward.
Branislav, it's great to have you back. The Index Standard has been a great friend of the show and a sponsor of the show, over the years. And I think that the work you guys are doing is very important. Branislav is very modest about having earned his doctorate, and I'm gonna say it even though he's shy about it. And Mike, glad to have you here as well. Very interested to hear more about your perspective. So, look, I think that the role the Index Standard is playing here is super important. We've had a proliferation of FIA solutions, and the good part is customers have more choice. The brands, different carriers are able to differentiate themselves in more ways because they're offering differentiated solution. All those things are good, but you have this issue of complexity and how one makes choices. So, Branislav, what are some of the ways that the index standard is sort of simplifying that process for your typical agent or consumer?
Yeah, so for me, I think it has to do with evolution, and then Mike, feel free to jump in on this one. But evolution of the product itself. That if you looked at the FIAs of 5 or 7 or 10 years ago, you had mostly benchmark indices, few strategies that were really meant to respond to different environments, and that was it. Over the last 5 to 7 years, we had over 100 indices coming into the play, multi-asset, risk control, and all the version and variations of it with all bells and whistles, and also the strategies that are now embedded in the annuities. And something that was a easy sell of like 4 to 6% type product with few choices, where you would allocate to I don't know, a third to 3 options that you have. Now, as Paul mentioned, you have 10, 15, 20, sometimes 30 options, and that approach doesn't work. So the simple story disappeared. And the question is, how do we help? Now our stance at Index Standard is that we firmly believe that carriers, when designing the products, are adding these options, to your point, Ramsey, to enhance the choice for the consumers, to give them better options for the overall in-force experience. But what we realize it's lacking is now reducing that down to 3 to 5 choices that an agent can present to their client across the kitchen table. Mike, what's your view on that? Because we had long conversations on this over the months.
Yeah, well, I think you hit a key point there in that 10 years ago, when you were allocating an FIA, it was pretty simple. Like you said, you put a third into the fixed account, you probably put a third into an annual point-to-point cap on an S&P 500, and the other third was maybe on a margin strategy to have some additional upside potential. But it was still on an S&P type strategy that maybe included some averaging. And if the index or the FIA did not see a return, it was easy to point to the why. The S&P 500 was probably down, or a lot of volatility throughout the year, and finished flat. But you could at least explain the outcome within the product. Today, when you've got like you said, hundreds of volatility controlled indexes out there, the majority of which are going to perform better during different conditions. But that's really where the industry has gotten a little complicated, because you can have an S&P 500 that's up 20% in a given year and a volatility control index that's up 3%. And the financial professional can't explain that why to the client. And they really don't have a lot of confidence in saying, okay, but this is what I think could happen with this next year. And so what the Index Standard has done is being able to bring that down to a handful of indexes that, we'll talk about it, but incorporates not only what we've looked at from a back test, but now giving a forward-looking approach to that. And ultimately, in the end, it's easy to lump all clients into the same model of they're risk adverse, so they're an FIA client. But there's a wide variety within that. But in the end, our financial professionals still need to generate a return for their client, and they have to be able to understand why.
So, Mike, so you have, look, you're at a critical point. You're the gatekeeper, right? There's lots and lots of people. Every bank, asset manager in the world comes to you and wants you to use their index, right? So tell us a little bit about, given the amount of choice you have as a manufacturer, how you make some of your decisions around what you think are the best index solutions to add to the menu. You mentioned vol control.
Yeah, so the first 8 years of my career I spent on the advisor side, and then I got into the wholesaling side, and for the last 18 years I've been on the wholesaling side, and then running the distribution for the last 7. So I've seen all sides of it, and to me, I've really not seen a scenario where simplicity doesn't win out. I think things have gotten overcomplicated with especially within this space. And you're right. Investment banks are always pitching new indexes to insurance carriers.
I used to be one of those people, by the way. That's just full disclosure. I was one of those guys.
Yeah. Well, and it's fantastic because look how much it's innovated the space. When interest rates came down, so hard, so fast, we had to innovate in this industry to be able to provide opportunities for clients to still generate return, to build indexes that had some more consistency in terms of how they're being able to be priced from year to year, just with all the volatility and interest rate fluctuation. So it's been a blessing to the industry through the innovation. And so now it's okay, how do we make sense of the complexity? And so for us, when we pick indexes, we want to be really intentional about having the traditional types of indexes and strategies that everybody's familiar with, but you've also got to have an index that's going to perform if interest rates drop. You're going to have you want to have some indexes that are perform when interest rates rise, but ultimately the core of our volatility control strategies we want to have correlate to a broad market index that an agent can easily determine why it did or did not perform that year.
And just one thing that's important to mention here is that it's not about picking the winners; it's about optimizing with what's there. And I think that was kind of the mantra for this project, is that diversification will ensure that there are no zeros on the statements most of the time, that you're doing the best possible work ahead of time to have that difficult conversation on why something did or didn't do on any given day. So it was a lot of fun for us to work with a team at Midland National and kind of defining and designing who these personas or who are we creating these models for. And maybe Mike, if I can ask you to speak to it a little bit, and I can then go into the how the watch is made on these models.
Yeah, so I mentioned in the end, we still need these products to perform and meet the expectations that they're designed to do. And really, the best way to do that is through diversification. And we've talked about diversification, heavily for the last 7 or 8 years here at Midland. But what diversification gets you is it reduces the zeros, the number of zeros, and it increases the frequency that a client is going to generate a return. And with that, there's I often think of folks who say, yes, an FIA is part of the portfolio that I need to have. But within that, there's these personas like Branislav mentioned, and I like to think of it as there's Mrs. Jones, the CD client, and then there's me, myself. And so someone like Mrs. Jones wants to see a return. She doesn't care that it might only be 1% this year. She just does not want to see a zero. Myself, on the other hand, I'm in more of a growth part of the portfolio, but an FIA as a diversification play makes sense as an asset class for a portion. I would rather get a zero, but have as much opportunity for upside that given year, knowing that I'm still in an FIA that I'm not going to lose money. So, and then most clients are going to be somewhere in between on that. And so that's where, having the 3 models really fits those 3 different personas for us. And, ultimately it's a great point of sale tool, but it's also a great tool throughout the cycle of that annuity when allocations come up every year.
Yeah, and just to jump in here quick, I mean, I think you make a real valid point. Is why do we have these options? It's not like if we rolled a dice and we came up with 20 options. It's just we have a lot of different clients with a lot of different individual needs, right?
And that was basically how we worked on the algorithms behind it. is to try and address, again, algorithmically, systematically, the needs of the three types of clients that Mike described. And if we just go quickly into what it means. So if you think about like ultimate conservative type of client, we mandate, so to speak, some portion to go to the fixed rate to make sure that account always goes up, even by a little. We make sure that even though we know on a long-term average basis, the strategies with fees do add value, that these are not included because, to Mike's point, Mrs. Jones doesn't want to see her account value coming down. And because we are talking about a very conservative person, getting credits every year is probably what they're looking for. So between the fixed rate, 1 year strategies, and no strategy fees, that would kind of form that first bucket of a very, very, very conservative consumer. If you move the needle a little bit into what we call moderate, we start by not mandating the fixed rate. Fixed rate is now an option. If it's a good option, it will be included. If it's not, it will come down to the index linked strategies. We still don't use strategies with fees because we want for this individual account value to at least be zero, so not to ever go down, even in the worst case scenario. And we give again allocations to the index strategies. Move that to the most aggressive version of the FIA consumer, whatever that means. We say that world's your oyster. There are strategies that will help increase your chance for the best returns. That's picking strategies with the longer terms, picking strategies with the fees where you get the additional upside that you buy through that fee, and provide those in a mix. So with these three presets, we map to the ethoses on the Midland National side in terms of how they bucket their clients, or at least how we heard that.
Branislav, on the walking through those personas is helpful, so thank you. I was noticing you recently have been running some polls of your followers and getting some kind of quick hit insights. So I wanted to talk a little bit about that. In particular, looking through all of where the answers landed, types of indices preferred, like the underlying theme of trust, like what customers trust and why, kind of kept coming up in the theme. So thinking through the three personas you just kind of stepped through, can you talk a little bit about sort of what they understand to trust versus what might be better for their planning and in meeting their goals, and how people kind of tend to still go back to what they think is better, even if the strategy says otherwise?
I think you raise a very good point. I think the key there is that people usually associate familiar with safe. And what we try to ask through these questions and tease out is, even if you don't trust something, why is that a case? Is it because it didn't perform well? Is it because you don't trust the people who designed it? You don't trust people like Ramsey who tried to sell this types of indices in the market?
Easy. Our indices did fantastically.
It really comes down to really understanding what's a trip up, because what we see observing the entire index universe, we see there are a lot of indices that are just a better versions of benchmarks. Again, keeping it very simple, but adding some new modern techniques to it to make it more stable, that make annuity parameter pricing more sustainable and predictable. We see a lot of indices that come from academic research that are they're grounded on the years of research, and again, Nobel Prizes coming out of that research. So I think getting people familiar with it and understanding what their gripe with some of these indices and how they fit into the entire story helps us hone our message a little bit better and help with our solutions in a longer term.
Mm-hmm.
Well, and I would add to that, just because an index doesn't perform on any given year doesn't mean it's a bad index. It just means it might not have been, the right conditions for it at that period of time. And that's where if you can take, historically the back looking illustrations, but then incorporate the index standard in it, from what we've seen, you've got something that is taking into account what, the analysts think is going to happen moving forward. And then the truth is probably somewhere in the middle between a back test about how these things were built and, what that forecast looks like. But it really allows, again, it comes back to just a little bit more information and to gain a little bit more understanding.
One other interesting thing that I think, Mike, is worth mentioning is that in the report that we make available to your financial professionals, we bring index descriptions, index narrative, all into a common denominator. Again, over 100 indices in like 5 to 7 years, marketing departments, positioning, sales, things that may look the same are given all different descriptions, and that's one of the missions for us at Index Standard, to make these as human as possible, so that, Tissa, to your point, people get comfortable with what these things mean, what they would actually do for them, and how these indices will respond to different environments. So, if index is multi-asset index, basically we talk about diversification. If index is shorting certain asset, we say, yeah, you can benefit from the fall of the prices of that index. Basically telling people what they may expect from an index, how that wraps in the annuity as a whole package, and then really driving home the point that it's not about picking the winner, it's about optimizing the product that is really, in most cases, well put together. It just needs to be optimized to your liking and your financial goals.
So, Branislav, if I can ask, in the index standard have been there for quite some time now. What would be your biggest surprise over the years? And in other words, I'm sure you had an idea of what constitute of a platinum index versus a neutral index a few years back. Fast forward that to today, maybe things have changed. Maybe your expectations have changed as to what an index, a platinum index versus a neutral index is today. What were some of your surprises or your shift in expectations over the years?
It's a loaded question, Bruno, but I'll go at it. So I don't think much has changed in what we deem well-built, thoughtful, high-quality index. And I think it's fair to say like nothing has changed on that front. I think one thing that we always try to tell people is that there is a difference about the engineering of an index, of a quality of build, of who the issuer is, how transparent they are with the methodologies, how complex things are under the hood with performance. And that goes back to what Mike was saying, that sometimes you have the best intentions and you have 2022 where both stocks and bonds went down and where things were meant to yin and yang, they didn't. So nothing you can do. So going back to your question, some of the platinum, gold, or silver indices also didn't perform well there. On the other side of the spectrum is your neutrals and watches, and you sometimes put this in front of someone and say like, why would you choose an index that has 30 or 40% allocated to technology stocks? So because that performs well. Okay, that as an idea is not necessarily earning the highest grades, but over the last 2-3 years, clearly won it in performance. So for us, really the ratings and forecasts are this balancing act of quality of build versus performance and how smooth the ride is on each and every one of these indices along the way. I hope that makes sense.
So if I can chip in, I mean, look, at the end of the day, markets are markets, right? And some assets perform better than others at different points in time. These indices have a lot of complexities in them, right? So you've got equities, you've got bonds, you've got commodities. To the extent that those are international assets, you've got decisions around what the currency exposures are. There's all these things that are going on. And so, they can't be expected to perform all the time. I think that the perhaps the biggest value I view for the kind of work that the index standard is doing is really making sure that when those assets do perform, that the index actually reflects the performance of the underlying assets. That it's not an index that has too many fees or too many other issues that would keep it from performing as expected when the underlying assets perform in a certain way. Again, not as expected for an unrealistic view from a user, right? Because they may not exactly know when things should perform a certain way, but like really as a function of them doing what they say they're going to do, the indices. I think that's an important sort of thing to elucidate and defend.
I think, Ramsey, you hit a nail on the head. I think you used the keyword complexity. And I think that complexity has increased over last few years. And I think we've reached the cusp. And I think people are now pulling back, both on index design, exactly to the point that you're making, that people like to see a tie to a familiar things happening, whether they're reading newspaper, listening to a podcast. They know roughly what's happening in the market. How is it reflected in an index that it's been chosen for my product? I think that also helps. Some of that simplification and innovation also helps in a product design phase to make the returns or credits inside of the annuity more transparent to the end consumer. So I think everyone wins, but I think that these are two things that we need to look at.
Yeah. Listen, I've been holding back. Tisa knows I probably invested, and Branislav knows I probably invested 6 months in this thing, Mike. So, so I have a series of questions for you. First, so if I'm a marketer listening to this program, or in an IMO, or I'm an agent, I guess I should go direct to agents, correct? Mike, yeah. So if I'm an agent, what are you putting in front of me? So what do I get?
Yeah, so I think everything we've talked about is up to this point has been fantastic, and then there's this extra piece, and that is how is this being received by our folks in the field, and we're 4 months into the pilot, so there hasn't been an opportunity to see how indexes that are in the forecast performed or anything like that. But what we can see is that there's a lot of things that have come out of this, Paul. So first off, the reaction from the field has been very positive. We just hosted a strategic roundtable. We do it annually. We bring in a dozen or so of our top partners. Essentially, it's a good portion of that is feedback. We use that to drive decisions that we make in our distribution. We were on the particular topic about product, and unsolicited, one of our advisors pulls up the monthly report from the index standard, and he says, "This is fantastic." And so, that jump-started that whole conversation. So they get a monthly report with the new forecasts around the middle of the month. And so the forecast is fantastic. And we know that it's being used, but what it really has done is open the door up to a lot of different types of conversations. Not only that the financial professionals can have with their client, but then also how my sales team and the conversations my sales team can have with the financial professionals. Things like my clients don't like fees. Okay. Maybe most of them don't, but maybe some of them would if the circumstances were right. Maybe they would pay a strategy charge to have an additional 30 to 60% participation that year. My clients don't like 2 or 3 year point-to-point duration strategies. They like to try to get a return every year. Okay, that's fantastic, but let's look at a 2-year strategy that we can ladder. And so you are generating opportunities for return every year, but you're taking advantage of higher participation by going out a longer duration than just 1 year. So those are some of the things that have made everyone kind of lean into those conversations a little bit more, that the report has kind of helped facilitate.
Well, that's great. On the same point, I'd be real interested to hear how you've thought about striking that balance between too little information, too much. And context, my experience was we had some actuaries who created a really interesting model, pulling all the going back in history as far as they could with the actual performance day to day of these indices. And for people to really understand the illustration models, it's interesting. The illustration rules, I think, of guidance, I think, has been really good for the industry. However, you are required to show a few numbers. Branislav, you can help me on this, but it's the last 10 years, the best 10, the worst 10, but that doesn't actually tell a full picture, because if you start, Mike, to look at distributions, to your point, this index on average, may be generating a 4% return, but it actually has a higher dispersion way up over a period of time. By the way, way down too. So, we were showing distribution curves, trying to experiment with this stuff. And I would say, some people latched onto it. We had some people in some of the firms who said, I love this stuff. It's great. We had others saying, hey, please give me the, large, medium, and small version of this thing. Check the box. Tell me about your thought process and kind of what was the feedback from these agents.
If you don't mind, I would like to go first, because I think this is a kind of show great partnership between two organizations, because every time we got too excited or too crazy with something, we had Mike and his team knock our heads back and say, like, guys, this needs to be simpler. And this is basically the only way you can do it. That there is an independent party and there is an interested party, and then you bring it together. And I think that's the only way you can find a middle ground. So Paul, I'm thinking that if we were to do this completely on our terms, we probably wouldn't strike the right balance. And Mike, maybe you can talk about that experience. But that was illuminating to me, that some things that made sense in the lab, when you put it in front of a sales team, in front of the actual financial professionals, we needed to work on it. And that was the biggest part of the project, and the most fun part as well.
Yeah, the collaboration was extremely fun, and it gives us more confidence when we ultimately go to market with something too. I don't know how many meetings we had, Branislav, where you guys kind of brought the methodology to us. We kind of gave our view. You went back, tweaked the methodology, came back again. We probably did that 3 times, maybe 4, before we kind of landed on the kind of the exclusivity that we wanted in each of the 3 models. And then I would describe for us then, as a result of that, the monthly reports that we get, it's everything we need and nothing we don't. It's very simple. One of the pages has the back tested, but then it also has, since the inception, of what the actual performance has been. Branislav mentioned the descriptions for each of the indexes. They don't just copy and paste the description from the index provider. It's plain English in their words. And so all of the descriptions across all the indexes flow. So it's just a number of little things like that ultimately made up, a lot of big differences and key wins for us.
Well, listen, this is great. We're almost, at the end of the time. Bruno, last question, thought, for either of our guests.
Thought. I think this is not of a question, more of a thought. I think this is great. I think people are embracing more those sort of ratings, the adoption of indices. So the industry clearly needed a player to cut through and sort through those things. So I'm glad it keeps on going, and I'm glad guys have a partnership with Midland, and thanks for discussing it today.
Hey, Tisa, how about you?
I guess my question would be, Mike, you shared the timing of the pilot being 4 months in, and so it's sort of being early. What is the plan for like further validation, further testing? Like, how are you working with your financial professionals to get feedback, client feedback? What does that process look like for you?
Yeah, so we hold Friday feedback meetings with all of our sales force. We have all of the key department heads across the organization on that call, and one of the standing topics is index standard. And what we're hearing, and in our team meetings, it's a standing agenda topic right now. So we want real-time feedback on how the report's being used. From the other side of it, we've got tracking metrics set up to see how many new allocations are coming in with either the 5 indexes in one of the models or the 5 indexes within one of the models exactly. And we've actually seen allocations come in exactly to the T, the percentages of one of the 3 models. And so, those are some of the things. That that we're looking at both from a qualitative and quantitative standpoint.
Well, those are great signals of success. First of all, Ramsey, thanks so much for bringing us all these indices.
Muted.
You're
I'm
on
muted
mute.
again. I know.
It's the theme of the day.
It's the theme of the day. Well, I didn't bring them all out. I brought out a couple of earlier ones. So we were early in the game in my last employer, kind of 2014, 2015. So we were very early in this process. But look, I think the key thing here is that at the point of manufacturer, this is an intellectual exercise, right? Getting to the right answer, the best answers is an intellectual exercise. At the point of sale, it's an issue of trust and confidence. And in between those 2 points, there's a continuum. And, agents and other folks in between are at varying levels of sophistication. They bridge the gap between the intellectual piece and the confidence piece. And so they play a very, very important role. So you have to have feedback going both ways. So one, you get the right answers in manufacture, and 2, you end up with something that even if an agent really understands it, at the end of the day, it's unlikely that even the smartest clients are going to get this most of the time, because they have lots of things they have to sort of figure out in their lives beyond just investment strategy. So it's a very important balance that we strike there. So anyway, I think what you guys do at Index Standard is a very, very important part of that process, and making sure that the quality is going downstream. So thank you for that.
Yeah, thanks, Branislav. I think what you're all doing is leading edge, and Mike, I think it's great you got it out to the field, because this is a tough balance to strike between giving guidance but not like investment advice that is going to come back later. So I think and sounds like agents are actually adopting and using the strategy. So I think it's good for probably everybody all around the industry. But listen, we'd love to have you back on in another 3 or 6 months and see how it's going, what the feedback is. But
yeah, absolutely.
Listen, go ahead, Mike.
I was just going to add, what you think, from a back-tested illustration standpoint, anyone can show an illustration that, is going to generate a 12 or 13% return. The reality is, at this point, where we're at in the market cycle, FIAs are a 4 to 7% type product. And when, back testing is great, but it doesn't show diversification. And so being intentional about showing diversification and the value of diversification, that's what I love most about what the Index Standard is out front doing. And, in the end, the more that we can promote diversification just across the industry, the better off we're all going to be, for sure.
Excellent. All right. Well, listen, thanks so much for coming. I want to thank our guests, our hosts, and thank our listeners. Be sure to share it with your friends, and we'll put links to learn more about Index Standard and what Mike and his team are doing at his company. So thanks for joining us, and join us again next week for another great episode of That Annuity Show. Thanks.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Spotify, or wherever you get your podcasts. You can also get more information or listen to more episodes at thatannuityshow.com. Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com.